This is Fund Fellow Founders Podcast, Story Short. Welcome back, ladies and gentlemen. Again, Akim and Tim over here, and this is show or podcast, you tell me. The name is still the same, FFF Story Short, episode number 4. Yes. And as we have done all times while doing this, let's start with the community update. Let's see how is FFF doing.
Exactly. Let's do that. So
over to you.
Yeah, I'm gonna go through our main milestones this month. So again, we are tech executives turned into the angel investors. We are community from the Baltics and the Nordics, where great people join us with a tech background.
I have to actually say that it's not only limited to Nordics and Baltics now, because we have people from Netherlands, Turkey, Egypt.
Exactly, yeah. I feel this is still applied for the region we invest in.
Yeah, this in this sense, definitely.
But in the same time, again, our mission is to bring 1,000 tech professionals into the angel investment by 2024. And we want to join rounds with the VC funds on the seed and pre-round A, round A stages. That's not changed at all. So again, we have a couple of points. We have new advisory board where we have great people like Martin Willig, co-founder of Bolt, Good Deed Foundation and the Estonian Founders Society. We have Erik Kaju, who is director of engineering and Spend and Wise platform at Wise.
Wise.
Exactly.
Ex-TransferWise, now just Wise.
Wise. And Victor Gelström, the founding partner of Ventures and Beck. So welcome on board, guys. We are keeping you updated, and thanks a lot for your recommendation, feedback, and being with us. So how we are doing? So we are 5 or 6 months in operations.
Yeah.
So it's actually 6. So we have 4 people in the team. So it's Tim, Akim, Dennis, and Anton. Hey guys, you are rock stars. Let's continue to push forward.
We have 126 members now. We will not name them all.
Nice.
But if you're interested, that all the information is available at the fff.vc. You can check who the members are.
Exactly.
4 startups funded, 1.1 million euros raised until today.
Yeah, that's amazing. And right now we are doing not only the equity rounds, but also convertible notes, revenue-based finance, and also secondaries, which we're going to touch a little bit later on. So we processed during the June 133 startups, which is super a lot. And since we have a rule to have 30% of our members to confirm the deal, it's getting a little bit more interested to process all those startups, and we are super picky nowadays. What else?
Well, we have expanded the VC partnerships, so now we are partnering up with 26 different VCs. Partnering means that we're exchanging the deal flow once a month. We're sending some deals to them. If they have something to share, they're sharing with us. And we keep active communication between the parties in order to collaborate as much as we can.
Exactly. And 4 main topics we are working on right now, and this is our main OKRs for this year. So first of all, democratize the angel investment class for tech professionals. So I feel we are doing great. So people are recommending to each other. So to join us, to track our activities, to track our WhatsApp group where we have different discussions about different asset classes, which is a great learning exercise for people who want to understand how this angel investment works. So second is establish external advisory board framework for founders to support their activities. So external advisory board is basically all our members. So founders can come to the members and ask any questions they like regarding the operations, fundraising, scaling the teams, and so on. And our members committed to answer those questions. And we have another 2 pieces which we're gonna touch a little bit later as well. So which is add on value to the founders we invest into. The third one, we established Estonian Swedish angel investment bridge. So far we've been featured in breakit.se, and it's a great story about how Sweden been impacted, gave the impact to Estonia, and how our tech scene evolved because of the Swedish telecom operators as well as the banks who joined back in the 90s.
Yeah.
So it's been a start, such a great push for our ecosystem to grow. And we believe that we have similar cultural mindset, and we want to learn from each other. So that's why we are expanding to Sweden and having more members joining from there. And the last one is to develop tools to make smart investment decisions. So this is our FFF engine, data scraping tools, where we get a lot of different data on the rounds, analytics, and we try to make some insights out of that, of course, which helps us to evaluate companies, to go through the due diligence process, screening, and of course, market competitor research. So which is basically the tool to minimize safe, fast time.
Yep.
And make smart decisions in investments.
And maybe just finally, for the summertime, we have also picked a bit more strict or harsh scoring criteria. How do we evaluate the startups? Again, as you may have known, everything is available on the fff.vc. So if you're interested, how do we score the startups now? Feel free to go to fff.vc and check it there. But if I'm not mistaken, we will touch it briefly later on the podcast.
Exactly. That's pretty much it. Our updates. Look for our newsletter in your email box, and let's continue our podcast.
And if you're not with us, then definitely join us, because investing together is fun. Story short. All right, and now we have Helery with us. Helery Pops is actually working with Honey Badger, not a fund, aka Capital. And if you're wondering which position is she taking there, it's everything. Again, aka she's a honeypot guardian. In more words, in more details, brief intro.
I'm also a professional ukulele player. Woo-hoo!
And I'm a drum player.
That's a joke. I'm not. I don't know how to do instruments.
I am a drum player.
All right. So yes, hello to the millions of viewers out there. My name is Helery, and I am representing Honey Badger Capital today. A brief intro about myself. I have been working at Pipedrive for a long time. I did sales there and research and product management as well. And then I went to work at Ampler Bikes as a product manager too, until my current partner Ragnar Sass gave me a call and said, let's start a fund. I said, no, I know nothing about funds or investing, but then realized that I could have quite a big impact doing what I do today. We have been doing this for a year now, and the setup is that it's myself, Ragnar, and then Martin Tajur and Martin Henk, who are all Pipedrive founders as well, and we have set it up in a sort of like a family office or a friend's office, or you could also see it as like a super angel syndicate. We do tickets that vary from 50 to 250,000 euros. We invest all over the world into basically all the sectors, but we do have our eye mostly on sustainability and green tech, because we want to save the world. You know, we've done 10 investments today, and there's like this little special part that I think we have as well, is that since we're that connected to Pipedrive, then we also include other people from Pipedrive when we do investments, or invite them to invest alongside us at least. So we make a ticket, and then we let the others know, like, hey, we like this company, would you like to join us? If many people say that they do, then we create an SPV for them, and they can join. They don't have to invest 100,000 or 200,000. They can join like with 5,000 euros. We put all the money together and get a decent size ticket, and also really good for the company that we invest in, because they also get lots of good people on their cap table who can help grow the company. And I guess that's a good segue into why I'm actually here today.
But to follow up on this, there's one more reason why Helery is here, and it's because in collaboration with FFF.vc, we have also launched a new initiative which is called Collectives. FFF has a mission of gathering 1,000 tech professionals by the year of 2024. So we thought, how can we get more angels on board? And with help of Helery and following the pattern that they have been doing with Pipedrive, we have decided that we're going to offer collectives of different countries, unicorns and future unicorns, or companies that are investing with their inner circle, an opportunity to get access to the deal flow of fff.vc and Honey Badger Capital, not a fund. I love not a fund, to be honest. It sounds really good. And we are allowing them to invest in their own cozy circle, delivering the deal flow from both of the companies, as I said. We will expand on this later on. We will keep the audience updated with the progress that we're doing. But maybe briefly, what is the status for now, and what is the next step for us?
Mm-hmm. Well, the status for now is that we have introduced this concept to quite many people already, have invited them to join us, and how it's going to work is that we will present them 2 deals each month, well, similarly to how you guys do it in FFF, give them the chance to invest, give them all the details about the deal, like what the company is like, what the team is like, because we have done all of this research before, and then invite them to invest alongside us. And I think if you would ask why we're doing this.
Hang on, why we're doing this?
Why are we doing this? Well, among other reasons, I think one of the reasons for me is just plain curiosity to understand how you guys work and understand how much those angels even want to be part of the companies. But in my mind, like the perfect vision of the world is that here in Estonia, we're a small community, and why can't we like create all the companies together? We take the people who know about front end and back end and design and marketing and so on. We put them to work sort of as advisors and investors in the companies that we want to create. And we just, as a country and community, build up the companies together.
Yeah, and also if there are people who have not been investing until today but would like to invest and don't know where to start or how does the process look like, we are there for them to educate, advise, and show how do we do this among both of our companies. So as I said, we will keep you updated on the news. Next step would be to serve the first deal, I assume, and add more collectives to the initiative.
Right, you are.
Right. So as I said, you will be updated if you're one of the workers of some cool company that is investing internally and you're like, jing, that's cool, then feel free to get in touch and let's include you as well, guys.
Hooray. Woohoo.
And now back to ukulele. Story short. All right, and I am back to my normal place where I'm used to sit. Thank you, Helery, for joining us today. More news to come. But let's move on with our common format of show, podcast, again, call it whatever you want. The news. I have picked some news, Akim has picked some news, and now we're going to share them, discuss briefly, and see where we will end up with this. Again, starting Akim.
Yeah, so the first one, I want to briefly touch the secondary market. So right now, in the downturn times, a lot of people, a lot of founders, a lot of angels or VC funds are trying to exercise their stakes, and they want to sell some part. Some of them are keeping the shares, but I feel that a lot of people are not still quite sure on how to make it properly. So the secondary transactions guide, this is something what we're gonna publish on fff.vc, and you're gonna have a look. So please find it there. But we want to briefly touch when should someone consider a secondary transaction, types of secondary buyers in the market. The most important one is how to evaluate this transaction, and what else coming after you did the deal. What's happening there?
So tell me.
Yeah, basically, so when should someone consider a secondary transaction? So there are a lot of different stakeholders, founders and employees, venture capital investors, leveraged buyout investors, and company itself. So there are, different situations different stakeholders have. Some of them just looking for the liquidity. Some have personal financial situation. There are different opinions among the founders or management or investors on when to sell the company. Some of them are still like pausing the IPO process, and longer you hold, like faster you want to exercise your stake and get the money back with some multiples. So there are like employees who are departure from their positions, and they are changing the roles, and they also want to get some liquidity. And of course, any investor wants to diversify their portfolio. So basically, to take some part and then reinvest back to the ecosystem to other companies. So that's pretty much the main how to say reasons exactly. And of course, there are tax reasons, tax planning reasons, and others. But what's happening next is that you basically want to navigate on the types of secondary market transactions. So what are the types? So existing investors or the company want to exercise. So like the angel needs to find the buyer, or a VC fund who invested in the seed round wants to find the buyer as well. So, and it's basically possible on deal by deal cases. So you have to come to someone else. So you have to find the buyer and then justify the valuation, the price per share, and just make the deal. But there are different stakeholders in this process. So you are the seller, the buyer, and also the company, the founder, and the board members. So there are multiple restrictions. So first one is that you have to have the board approval of this transaction.
For every transaction?
It highly depends on your SHA and the legal docs you signed as when you did the investment.
So in some cases you don't need the approval from the
exactly,
founder.
yes.
Okay.
So you have to carefully read the documents you sign when you invest because you are limiting yourself this way. So please be aware of this right or restriction. So that's really, really important. And what is the process? So, of course, first you have to evaluate. Right now, there are a lot of deals with the discounts. They are different. 10% discount. Some of the people selling with 70% discount. The reasons are different, and right now is like the market is scary, and it seems like downturn is happening. So people want to get more liquidity to prepare for it, maybe to buy some other shares in other companies. But the limitation is that you basically, there is no exchange where you just trade your shares, where there is high supply right now, but there is not really a huge demand because people are still waiting. They are really conservative, risk averse. They trying to evaluate what is the best possible deals on the market right now, and it takes some time. So the buyers are really in good position right now. So they are really selective. They really go through and they want to check other companies right now. So, of course, there are plenty of things what we can share about the secondary, but the valuation is basically really the key here. So in order to get right valuation, you have to actually have the data of for the company, the recent data, and you have to evaluate the multiple factors, P&L. You have to model the growth, the potential growth of the company in the future. So for next 2, 3, 4 years. So there are different modeling techniques you can take as a benchmark if the company gonna invest in their growth, or they're gonna become the break even, or they just gonna stop some activities. And there are multiple things to consider, variables in this model. So if you have the data, you can simply calculate, but you have another issue which is coming next, that you cannot disclose this data to the buyer. So what to do here? So
NDA.
Yeah, exactly. But you cannot transfer since you have another NDA with the company. So the buyer have to trust you. So, and of course, buyer have to have additional mile and check maybe to speak with the employees, hustle for the data in different sources, look for the previous investors, primary in the previous primary round, and so on. So there are multiple things to consider. So the valuation is the key here, and after you made the deal. Of course, you have to be aware of accounting principles, the taxation, what is happening, and so on. That's something what we covering in our material, which sits in fff.vc, and you can simply have a look and navigate yourself. Of course, we cannot touch different jurisdictions, but we try to sum up the experience we had with our secondary deal there. So please have a look and let's move forward.
No, not yet. I have a question. I have a question towards the topic.
All right.
So in my world, every time somebody is selling secondaries, first thought or first impression that I get is that there's something wrong with the company. Why would you sell if company is doing good? You mentioned some of the reasons, but what is your take on this? Do you react the same way? Why do we straight away start thinking like this? Why is it like this? Because for me, it needs convincing that no, it's a good deal, that the company is doing well, but for some reason I would like to sell the shares. So what do you think of this?
I believe you have to understand the seller's, first of all, motivation. You have to trust the seller. So why do you sell? This is the most open question what we can ask, and so then the listen. As I mentioned before, there are different motivations. So first of all, the motivation. Second, you have to understand the process. So it's not really fast process. You have to evaluate a lot of data, hustle for this data, and then make the decision. Of course, you have to have a decent discount in order to make it even faster. Third is the volume, the size of transaction. So if you understand that this particular seller is not selling the whole lot, the basically.
So he keeps something for himself.
Exactly. So then pretty much it's justified. So you bearing the risk, the investor is still holding the shares. You can later on look into the information and basically, if someone gonna keep the shares, it's still totally fine. It's safe. It's safer than if the seller selling the whole portion. And of course, timing. Transactions happening in different times. So of course, in the economic growth times, the pricing of those secondary shares are higher than in downturn. So it sometimes, in most of the times, it happened in that way that people are just being so conservative or they didn't think about what's going to happen in 1 year. So, and they just started to panicking. Something goes wrong with the market, so I'm going to sell. But it's again down to motivation. So what's happening, how much stake he or she still keeps, and then the other only lays on the information you get.
It doesn't mean that if you have secondaries offer, it doesn't mean that something is wrong with the company.
Of course.
There are a bunch of reasons why people might be selling this.
Definitely, exactly.
All right, let's learn for myself, because normally when you get those, straight away you start thinking, why? What's wrong? But now you have reasons. Now we can move on.
Story short.
All right, let's move on. And the second part of news comes from Sifted. And the article that I found, which brought my attention, was called What Should I Do? My CTO has walked out during the fundraise. And the article was structured in a way that the person in need of help approached the resource and asked them the question. So what I would like to do is I will read out the circumstances or the entry point of this, and I would like to hear from Akim what he would do if he would advise this person. Later on, I'm going to comment on what was suggested in the article, what did the other people suggest for this poor founder whose CTO left in the middle of the fundraise. But the problem states this. We are in the middle of a pre-seed race, and our CTO slash co-founder just bailed on us, and they want to vest shares before the cliff is reached. The worst part is that we can't hire a new CTO before we secure funding, and we can't raise funding without a CTO. What advice could you give them? The situation is quite sticky.
Exactly. I feel, first of all, you have to understand, again, back to the first principles, what kind of product are you building?
Yeah.
Nowadays, in this world so first you have to solve really big issue or challenge. And for me, the technology is just a tool to actually make people
make things happen.
Exactly.
Actually. Yeah,
exactly.
Yeah.
So, of course, you have to have a strong CTO in a deep tech startup or in some clean tech startups because it requires a lot of knowledge or specific information you have to handle. So. Or alternatively, you have to have the network of people who is in this niche. So back to the question, I feel that you have to first understand if you can survive without the technical person. If it's a software as a service startup, most probably you can get another co-founder, or you can get the person, the high skilled person in your as your employee with a really great option pool to give him or her strong motivation to continue. Since it's a fundraising process, you have to be clear with your investors. So you have to be super transparent that it's happening right now. You cannot just avoid it, and this is not related to the company. Or actually, you have to be also clear with the why it's happening. So maybe, the person just lost the confidence in this product.
Yeah.
So it's better than this person gonna leave early.
Yeah.
So because it's just gonna ruin the next fundraising, or it's gonna ruin the whole partnership dynamic. So that's why.
Yeah, go ahead.
That's why I believe we every time we are kind of looking into the deals, and in our first workshop we are checking for founders' intelligence, integrity, and partnership dynamic. So that's really important.
Should you do the fundraise without CTO, or should you find an intern CTO? What out of those two would you advise?
If you're gonna be alone, and if you if the spark in your eyes, and you are really doing something what is needed for the customer audience, then it doesn't matter who is actually fundraising. I mean, it's only about yourself. So number of people doesn't matter. But anyway, the investor is gonna speak with your team members, with your C-level guys, and gonna understand if it's actually decent, if they have decent backgrounds, and most of the time, is it seed or round A or
pre-seed
stage? So it's again lays on the founders. Of course, it's a bad sign, but if the company is not really tech heavy in their idea, but I feel for me it's still fine to go
alone.
Exactly.
And last one, what about the shares?
Vesting.
Yeah.
So vesting all the time.
So the CTO is leaving, and they want to vest shares before the cliff is reached.
I feel it's not fair on this stage. So pre-seed. So what did you do in pre-seed? Most probably you hustle for problem market fit. So you basically look how to solve the problem. Most of the startups in pre-seed stage have only just landing page and some sort of validation, customer development, research, or interviews. The most probably the technology gonna change over time because you're gonna evolve yourself. Customers gonna check your like products, or right now there are a lot of different no-code tools. So most probably, if it's again not tech savvy, you just can code with no-code tools. Just plug and play, and then check and validate the problem. So on this stage, I believe it's not really. I have not seen those guys who actually just like been so heavy on the shares at this stage. They just been agreeing, well, I'm not the best fit, I'm out. So and in the majority of the cases, they just got some option pool shares, and that's pretty much it.
All right, so now let's check what did the experts say. So there are three different people who have been commenting on this. One decided to stay anonymous, but you actually touched this. First advice that they suggested to the founder was to make sure that your support network, advisors, investors know what is the situation.
That's clear.
Because this is kind of the baseline. They should know if they are coming on board or they are already on board. The anonymous person is suggesting not to say no to share vesting. Exactly for the reason Akim gave. It's too early. They don't believe that the dependency at this stage is so big. And if the person is leaving you at the critical moment, why should you reward the person? You can still be friends and you can still go separate ways. But there shouldn't be any additional value for the person who is leaving, actually. It was also suggested to try and find the CTO as soon as possible, to still do the fundraising. On this stage, I think it's actually a bit doable. Totally, the dependency might not be that big, so you can actually do this. Definitely get all of the wisdom from the CTO. So all of the knowledge and all of the processes the CTO has been building up until this point. Definitely make sure to get the knowledge to pass it on to the new CTO, because if you don't understand this yourself, it's quite difficult to onboard somebody new to the company. They also suggest that angel investors and early stage funds, because we're talking about the pre-seed stage, are quite okay to invest even without the CTO. That's actually what you mentioned as well. So if dependency matters, and also the field of business matters. Again, like Akim said, if it's a deep tech, quite difficult. If it's basic SaaS at pre-seed, maybe it's good enough for you to raise without a CTO. And definitely prepare the short list of potential candidates, because they advise that if you will be fundraising and you don't have a CTO, it's actually adding value when you will be presenting a slide on a pitch deck to the investors saying that I don't have a CTO, but these are the shortlist candidates for my position. So to move on, the ex-CTO of Monzo and Helix said to hire a interim CTO. Which in my personal opinion is a bit odd, in the sense that what is an intern CTO? So if you hire somebody for the process of the fundraising in the pre-seed stage, what exactly is the role? So either you hire a new one who's taken over, or you don't hire. Maybe I'm wrong, but for me, just a bit odd to be going through a startup and see that, oh, there's an intern CTO for the fundraise. What does it mean? What value does it add? Was he properly onboarded? Can he answer all of the questions, like the story questions about the startup and so on? And what founder and managing partner of ACF Investors are saying that, or advising that the priority would be to keep him as long as possible after the fundraising round has been completed. They are suggesting that if needed, give out the shares, let him stay. But it's super important for the investment, at least for them, to see the CTO who has been a co-founder specifically from the start. It's really important. And again, they are suggesting to hire an interim CTO. Maybe I'm with a completely different mindset, because two different people have suggested it. Maybe I have not seen those situations. That's why it's a bit, unnatural for me. But basically you covered quite many points out of what those people suggested. And if you are the founder and the CTO have left you before the fundraising round, then now at least you have some guidance how to tackle the situation and what to do, with help of Sifted experts and Akim.
Just rock it. Just rock and roll.
So can you imagine the guy comes to you and he's like, hey, I have this problem, CTO left, can you please advise me? And you'd be like, you know what? Rocket.
Rocket, and you just like take the guitar. Dun, 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 dun.
Today we had ukulele. Ukulele is good enough as well, or guitar?
Yeah, that's fine. That's
Okay.
totally fine.
All right, let's move on to the next news. Story short.
The next one is about Norrsken Impact Report, just published recently. So the Norrsken is discussing on how they apply the screening and due diligence principles for their leads or deals or startups who are coming to them, and it's really, really insightful. So you're gonna find the report below.
I feel myself like a YouTuber.
Exactly. So overall, entire investment process explained in very detailed way in 5 steps. So basically deal screening, due diligence, deal structuring, investment management, and exit. So mainly what Norrsken managers want to say to us that you have to apply impact measurement for each startup you invest into. So, and how to make it possible? So we first have to evaluate impact potential using their impact framework assessment. So they request company to analyze the data on impact and including sustainability questionnaire that defines impact potential. They of course set up impact KPIs for every single company they invest. So for example, for Mad Smart Potatoes, so this is the company which is basically sell groceries online, helping the big producers of FMCG.
Check the website though, super stylish website. Sorry.
Yeah, amazing one. And their impact KPI is tons of food saved.
Yeah.
So super straightforward. You have to save a lot of food, and yeah, that's totally great. And Norrsken also invested in the Estonian company called Grünfin.
Yes.
And Alvar, the Alvar is our member, and we really love what you are doing. And Grünfin's impact metric is basically assets under management in sustainable investments, and of course number of users. So basically it's all interconnected. So more users you have, more sustainable investments people do. So, and a Grünfin platform process. So yeah, Norrsken trying to identify the KPIs, they track it over the time, they ask founders to be compliant with those principles, they ask for the reports on a quarterly and annual basis. So that's really innovative. I believe by publishing those reports, they basically set up the high bar on assessment. So this is something what all VC funds have to do in the recent years, and I love to learn from them. And we're definitely gonna learn and apply those principles in FFF screening as well.
And I also feel that it's actually limiting the chances of getting some greenwash company on board, because there are quite a lot of green techs and clean techs. Sustainability is the buzzword at the moment, but when you start looking, there are really a lot of companies who don't actually do anything which falls within those categories. So I think when you have this, how did they call it? Sustainability KPI or sustainability metric?
Impact KPI.
Yeah, impact KPI. It's super straightforward. So how do you evaluate your impact? I give you one metric, and you understand straight away what is the company doing, how are they helping, without any bullshit.
Exactly, and if more companies gonna provide their impact assessment reports, so better the founders understand their own OKRs and where to chase not only the revenue or MRRs, but also how to calculate the impact in the right way. And the company called Sustainair in Estonia is doing those reports, and I feel nowadays it's mandatory for all those public companies who are traded right now. So I feel even more private companies gonna apply those principles. So learn from the Norrsken. I believe they are trendsetters. So
and share what you learn.
Share what to learn. Exactly.
That was smart. Moving on. Story short. The next news is coming from me, and the next news is stating what would the recession mean for revenue-based financing startups. So we have been quite strong advocates of this revenue-based finance, or generally speaking, alternative financing model At the fff.vc, we have been offering several deals to our community to see if they would like to give loans or even revenue-based loans to the founders that approach us. And now it would be interesting to learn how is the economical downturn affecting the revenue-based financing startups.
Yeah.
So some key takeaways from the article. Since 2017, 18 revenue-based financing have emerged in Europe, raising a record 671 million from the VC last year alone.
Crazy.
Not from 2017, but last year alone. So 671 million from VCs in the last year alone. Revenue-based finance providers are exposed to interest rate fluctuations, which means basically that if the customer or if the clients who they're giving the loans out are doing well, they're stable and doing well. If the customers and clients are starting to face some issues, then it affects the generally speaking, the business of revenue-based finance startup as well. Revenue-based finance worked pretty well in the good times, like 2020. When the SaaS startup market was worth 145 billion and annual revenue increase on average was 78%. So when everything is booming, when everybody was doing SaaS businesses, raising for the SaaS businesses, offering to the SaaS businesses, when the consumers who are using the SaaS businesses had an opportunity to use them as much as they want, everything seemed really good. Now, it's not too good because unsecured credit is the weakest one when the economic is facing downturn.
Yeah.
Again, we're coming back to the basic understanding. If you're doing a SaaS product for the consumer, if the consumer doesn't have any money, then you don't have good revenue. If you don't have a good revenue, then the company that you took revenue-based finance from is not generating enough money to cover the loan that they have given out to you. It creates friction between the companies, and affecting negatively the revenue-based financing startup then. Last week, London-listed VC firm Forward Partners published its annual report of 2021, including one of the division of the fund, which is Forward Advance. They're doing specifically revenue-based finances. Okay. So they're saying that within the next year, they had to write off 8.4% of the credits given out. So almost 10% of the credits that they have given out had to be written off because there's no business left. So they gave money for the revenue purposes. There's no revenue, there's no business, they're not generating anything back. They have to write off the costs. They're claiming there's no panic at the market just yet, but the analytics shows that revenue-based financing companies are monitoring the market closer than anybody else because, as we just talked, they are dependent on how well is the market doing and how well are the SaaS companies doing on the market.
And it's not only about the market itself, but also about the access to the financing. So if your portfolio is performing quite badly and you don't receive the returns, it means that nobody gonna give you the money on the great terms. And for revenue-based financing, I believe the lower the interest rate is, better the company gonna perform. I mean, more they gonna earn. So, I have many friends who are working in uncapped. It feels like it's hard times right now.
We will touch this in a second because when I said that article stated there's no panic on the market just yet, it is worth to mention that there have been already some layoffs on the big players in the market. For example, Klearco has laid off 10% of the personnel. This is a company that is offering revenue-based finance to the other companies, and Uncapped within May and June have laid off 26% of their people. So
I believe the luxury of this business model is that you just first of all you stop giving out the loans. Of course, you have to somehow transform your business and basically onboard your recent customers on maybe some cross functional products. Like maybe bank, neobank. I have heard that Uncapped been working on this. So of course you can keep the relationship with your clients. You don't need to loan them just right now, but you can just readjust your pace, the strategy a bit on how you earn money or what financing options you are providing to those. And then after some time, you can again reissue the credits.
Yep.
But of course, you have to remember that you already loaned so much money, and if the return is not going to be so great, most probably, you have to completely change the strategy.
Yes, I completely agree. And it was mentioned in the article as well that try to create another fintech product from what you have been doing, because you need to start pivoting in one way or another, because if you're not a big player, most likely you will be facing difficult times ahead.
Okay.
Also, one takeaway from the article was that you should diversify. If you're speaking about revenue-based finance, then normally you have SaaS and e-commerce in your mind when you hear those words. But now the investors are suggesting the revenue-based financing companies to start looking elsewhere, maybe take some bigger risks on some new verticals, but definitely validate, verify if you could be diversifying, not working only in two quite narrow niches, which are SaaS and e-commerce. And finally, as with everything else, I heard a lot of people talking this about crypto and the crypto situation at the moment. In here, it's exactly the same. So investors actually see it as needed market cleanup, because apparently there's so much going on in the market, and there's so much,
money.
Yeah. They would like to see smaller players disappear, and everybody who's not prepared for this disappear from the market with this downturn, and pave the way for people who have been thinking it through even more or better way, the more mature companies. And they believe that the mature companies will find a way how to keep afloat, while the smaller one will most likely face really, really difficult times on the market.
Exactly.
Nevertheless, for me personally, I still think that this is an amazing funding method for startups, for certain startups. And we have been seeing that, again, Scramble is doing quite well as far as I know. They have been growing in the past half a year, how much we have been monitoring those. So we really think that this is a good method how to get funded if you don't want to get equity away. But now, if you're a founder, it's just going to get hell more tricky to secure revenue-based finance for your startup. So maybe giving equity is better, or maybe not. We don't know. That was just the news that I shared. Anyway,
no investment advice.
No investment advice at all. I'm just sharing the news, and as usual, we will link everything below the video so you can check the articles yourself. And I really encourage you to read the revenue-based financing one. I found it really, really interesting and good for educational purposes.
Cool.
Moving on, story short.
The next one is about the state of the market. So we all remember in the late May, the Y Combinator is actually published their own note about, hey guys, you have to go and raise now, like already yesterday, because there are unpredictable times ahead. So, and it's hit.
It was like this as soon as the article, I don't think it was an article, they sent it out in the groups of the portfolio companies here in the newsletter. So I remember this day really well, because I received it from at least 5 or 6 different people and saying like, okay, sorry for the wording, now we're fucked.
Yeah, exactly.
And everybody was like, okay, what should we do? What should we do? What should we do? So is it that bad?
I feel no, because after June and July, we came back to our VC partners who we co-invest together. So it's 26 partners, and we gathered quite a lot of information from them. So how did they pause investments? No, they didn't. So everyone is continuing investing in the quality companies. So the quality companies is basically the metric is quite fairly simple. So how capital efficient they are. So how much they spend. So how much basically capital they have right now. What is their burn rate? What is the what else?
How sustainable is the company? I mean, this became super crucial. They as I think it was Sequoia's report said, hypergrowth is not a king for the time being. Sustainability, or getting close to sustainability, is the king at the moment, because the more risks you're taking at those challenging times, well, in the bigger hole or in a deeper hole, you might end up when things go south. Exactly. So this is really, really important. The sustainability, how well can you manage your funds, how much can you explain how and why do you manage those funds and so on?
Same time, the valuations and multiples have reset around 30%.
Yeah.
That's like a no-brainer here. We all see that the public markets are actually down to like 65%, and investors need to figure out how to get a return if you succeed.
Well,
so less capital doesn't mean less transactions,
No.
to be honest, but means lower valuations.
Well, you talked about, you touched the valuation part. I mean, I was preparing it for the next news, but let's just mix them both. I mean, we're talking valuation. There's no better example than Klarna.
Exactly.
I mean, from $36 billion, the company is now planning to set the valuation in the next round at about 8 billion.
Exactly.
So this is enormous downturn from the valuation. And in this sense, well, at least I believe that this is one of the ways how the world has been affected. The bubble of the valuation is a bit bursting. It's really difficult to... So the way I see it before, it was, hey, I have a startup, this is the valuation. And because there was so much capital and the capital was quite cheap, it was like, yeah, all right, I'll do this. But now you need to justify why does your startup actually is worth like this. And with the Klarna case, it's actually nightmare because it affects the previous investors. It affects the employees because they have an option packages, which some of them became worthless. Basically, now they're actually rethinking the structure.
Yeah, just to feel it. So the valuation of the company from current level will have to increase X7 to reach this break-even point of 46 billion.
Yeah, so in this sense, it's definitely true. The valuations will go dropping down. The biggest companies on the later stages, we assume, will get affected the most. But I just wanted to comment on the valuation because I was actually about to speak about the valuation in the next news. So sorry to interrupt. Can you continue?
I mean, I feel that the most recent important part is that investors care much more now about who will fund yourself next. And a year ago, again, everyone assumed that the money is quite cheap. But nowadays, you have to have really strong VC fund behind in order to continue invest in your company in the downturn. And of course, that's something what we trying to do. So while we invest, we cooperate with our super great partners, and we believe that we're going to exercise our pro rata, and they're going to also support the company growth later on. So read about our downturn principles for angel investors and for the founders in our website, fff.vc. Just scroll down. It's going to be the quite heavy article.
It's becoming a knowledge base, not a website. It's because we're always referring fff.vc. But we are posting everything there. We try to be transparent and we try to offer as much knowledge as we can to the members, to the founders, to everybody else who may find it interesting. Regarding the investors and who's coming on board, I would also say that clear pattern that I started seeing now is investors who are coming aboard are also more interested in who is already at the cap table from the previous round.
Yeah, that's true.
Are they able to do the follow-up investment when you're doing the next funding round? Are they proactive investors? Are they limiting the risk or adding the risk because somebody from the previous investor is really hands off, if you can say so, and offers no additional value to the founder? So I would say, to sum up, as Akim said, read everything at fff.vc, but to sum up, everything became way more detail orientated and sensitive. If previously it was, I'll take a risk, now it's, can you please explain why? Sure. Okay, show me this, show me that. So it's becoming really strict and like detail orientated, as I said.
Yeah, it is. So that's why we are agreed to readjust our own screening and due diligence principles in the beginning of summer. And I feel we're going to come back to this again, review this in September.
Yeah.
So we are adopting, and startup founders have to adopt as well.
Yeah.
Just a game. I believe the playbook is changing over the time, but it's all cycles. So in some point of time, we're going to come back to the growth cycle as well.
Sure. We've seen the recession before. We see it now in some aspects, but after dark night, there's always a bright day.
Yes.
All right, and that's slightly awkward. Yes, we'll finish off today's podcast. Thanks for being with us. Check fff.vc for all of the information. I will link everything below so you can read through the articles and check the reports that we have been touching today. And we will be back with you in August.
See you.
See ya. Story short.